Well, good morning. It's Friday, February 22nd, 2024, and I am Kenny Polcari, your host of the party, and it's Groundhog Day, right? So let's see whatever he is, the raccoon, the gopher, whatever he is, what he has to say about how long winter's going to drag on. But here are the things you know, because there's a lot going on in the markets, and I'm not so sure the Groundhog has anything to say about that. So the March rate cut narrative is, guess what? Not dead. It's unbelievable. Tech, which led the way down, now is leading the way up once again. Why are you surprised? Amazon and Meta just tear it up, and Apple gets slapped by China. It's NFP day. Estimates are ranging from 110,000 new jobs to 250,000 new jobs. Factory orders and durable goods are due out after that. And what do we have for dinner type? We're going to have the Porcini rubbed bone-in ribeye Tagliata style. Okay? Now, stocks rallied hard on the day after. The Dow gaining 370 points or 1%. The S&P added 60 points or 1.25%. The Nasdaq surging by 200 points or 1.3%. The Russell added 27 points, up 1.4%. The Transports rallied 130 points or 0.8%. Now, the rally had multiple parts. The first part was fueled by the idea that JJ wasn't convincing enough on Wednesday. Yes, he said it's not the time. Yet some people heard, not so fast, buddy. There's still plenty of economic data that could force you to cut. And so the March rate cut narrative remains alive and well, even though JJ said we took it off the table. Now, today's NFP report may just be that data point that they are pointing to. The rate cut guys think it's going to be a weak number rather than a strong number. The estimate calls for the NFP report to show an increase of 180,000 new jobs. The rate cut guys are saying that the whisper number is more like 110,000 new jobs. And that, in their mind, means that's a weak number, and that means a rate cut in March is still hot on the table. While the hold the rate here, guys, myself included, are predicting something stronger than the estimate, right? Now, Goldman, they've got a 250,000 number on it. And if that's the case, then you can kiss any idea of a rate cut in March, May, and June. Kiss it goodbye. In fact, if the NFP is that high, then it's going to be the rate hike story. That narrative will be reborn. Unemployment is expected to come in at 3.8%, historically low. Remember, economists say that the unemployment rate has to have a 5 handle on it before we see the CPI at 2%. And we're a long way away from 5% unemployment. But layoffs did surge by 136% in January. And that is a concern because at some point, those people have to start showing up in the data. And so again, I'm in the camp that a March cut is not on the table. But if they want to take stocks higher, I don't mind. I'm happy. I'm invested. I am happy to go along for the ride. And then there's part two. The rally fueled by the very names that led the decline over the last week or so, ahead of the earnings out of Apple, Amazon, and Meta. And why is that? Because investors finally decided that the overreaction to the most recent tech reports was just that, an overreaction. Look, could the rally that began in October, that priced these stocks to perfection, have anything to do with the latest response? Of course it does, and of course it did. They took those stocks right up, kissing the highs. They couldn't do anything but take money out of them because it was impossible to beat. Yes, AI is a major story. It isn't becoming the major story. It is the major story. And there's a lot going on there, much of it well known and already priced in. The earnings reports and the guidance were, in my opinion, outstanding. But it was almost impossible for the stocks not to sell off because you can't tell me that Microsoft's 33% profit surge powered by AI is a reason to sell the stock. It's illogical. And nor was it logical for long-term investors to sell Google, Amazon, Apple, and Meta and AMD, right? But people did sell those names. The trader types doing nothing more than locking in profits, and the big asset manager types are doing what you pay them to do. Manage your risk. Now, asset managers that sold some of those names are doing so because they need to manage the overall risk, right? They're managing billions of dollars. They need to make sure that they are balanced both in theme and in weightings that reflect their portfolios. So when the prices of some of this stuff causes these portfolio weightings to skew out of balance, then policy demands that they have to figure out a way to bring it back in line. And most of the time that means that they just peel some off, right? They take some of the outperformers and they reallocate or hold some of that in cash, just awaiting another day. And according to Bank of America, institutions like mutual funds, insurance companies, pension plans, etc., last week sold the most U.S. equities for a single week in a decade. Goldman Sachs' tactical specialist and managing director, Scotty Rubner, tells his clients this, and I quote, "If the U.S. stock market goes down a little from here, it could go down a lot." It's amazing. And to think Goldman clients pay for that insight is absolutely amazing to me. I'm not even sure what the guy said. In any event, some of that newfound cash either stays in cash or gets reinvested in other sectors or other asset classes. Now, bonds come to mind. And in fact, while the stock indexes were getting slapped last week, the bond ETFs were rallying and bonds were rallying. The TLT gaining 5.8%. The TLH was up 4.5%. And that sent bond yields a little bit lower. The 2-year now yielding 4.23%, and the 10-year is well below 4% at 3.88%, right? A low not seen since December of 2023. Now, drum roll please, because then, after the bell, it happened. Apple, Amazon, and Meta, they all reported, and they killed it. Amazon and Meta surging higher, and Apple got trounced. I'm really not sure why. Apple earned $119.5 billion in 1 quarter. That's 3 months. iPhone revenue, $69.7 billion versus $68.5. And then here's the problem. Greater China revenue, right, of $20.8 billion, down from $23.5. And so for that, they took 6% out of the stock in the after-hours session. Are you kidding me? They just earned $119.5 billion in 3 months. I don't care what happens in China. I am not selling my Apple because of China. In fact, on the weakness, I'm buying more because it's ridiculous. But this is exactly where a large asset manager will peel off some of their Apple, right? Apple's 6.6% of the S&P. So if he or she is overweight in their portfolio, say Apple's 9% of their institutional portfolio, then it begs the question by the boss, hello, why are you overweight Apple? Did you see what's happening in China? Bring your position in line. And so what do? They sell stock. It's nothing more than a math problem. The fundamental story for Apple did not change overnight. The weakness in China should not have been a surprise if you've been paying attention to the conversation over the past 6 months. Now, just FYI, the panic selling in Apple that happened after the bell last night was really ridiculous. It's taking the stock down 2.5% this morning, leaving it sitting directly on the trendline support at 182.50. So here's what you need to consider. Will it hold that line or will it breach that line? A breach could see it really pull back to the mid-170s. Okay, that would represent a 12% pullback off the December high of $199.96. All right, that's a pretty nice sale in Apple. Meta is surging by 16%. And what was their golden buzzer? Well, they threw 22% of their people out in 2023. They tripled their profits. They announced a $50 billion stock buyback, and they announced a 50-cent quarterly dividend. Do I need to say anything else? This morning, the stock is quoted up $65 a share. Did you see the post about the person who's unidentified who bought 32,000 calls yesterday before the announcement, conveniently? That's equal to 3.2 million shares of Meta. And then at 4:05, Meta comes out and announces all the good news, and bang! That trade produced a $160 million profit. Amazing how that happens, no? In any event, that is what it is. Somebody should really figure out who that person was. Now, in preparation for today's NFP report, yesterday's initial jobless claims did show a minor increase. Labor productivity advanced. U.S. factory orders climbed to the highest level in more than a year and a half. These are not results that scream for a rate cut, but they just can't let it go. And by the way, neither can Goldman, Bank of America, or Barclays, because these three investment banks are also sticking with the March narrative. But again, Goldman's confused. On the one hand, they're projecting $250,000 job creations today, yet at the same time, they're calling for a rate cut in March. Hello, anybody home? This morning, futures are higher. The NASDAQ is exploding up 182 points. The Dow up 10, the S&P's up 30, the Russell's up 3. Again, I would just be careful about chasing any of these names up here. If you're establishing a new position, just go easy. Feather it in over time. If you already own it, you can celebrate. If you want to add some more, be patient. Buy it on a pullback. And if you want to take your money off the table, then hit the sell button. Now, expect all kinds of analysis over this NFP report today. In addition, we're going to get to factory orders, expected to be up 0.2, and durable goods orders. Those are expected to be flat. Now, that doesn't make sense to me. Why not? Because there's a lot of building going on. New home sales were up 8% month over month. Construction spending was up 0.9% month over month, which means there's a lot of demand for what? Durable goods. Think appliances, AC units, heating units, consumer electronics, furniture. So if durable goods comes in flat, then there's a disconnect somewhere. Just saying, I mean, are we going to build all these new housing units and then not put in a kitchen or an AC unit or a heating unit? Where are you going to sit? And how are you going to control the smart house without any consumer electronics? And so therefore, that should be an interesting data point to see how that comes in, because it's not making sense to me. Oil fell yesterday. A tested trend line support at 73.80 on rumors that there was a ceasefire between Israel and Hamas, right? That was later denied, but it is true that a proposal has been offered. This morning, OPEC Plus is keeping production and output policy in place, and the Saudis hope that that's going to keep supplies tight enough that will force prices higher. WTI is up 35 cents this morning at 74.20 a barrel. Gold shot higher over the past 2 days on concerns of global real estate meltdown, which would increase the likelihood of a March rate cut, and that sent the dollar down, bonds up, yields down, and gold up. Gold did trade as high as 2,080 yesterday before closing at 2,071. This morning it's turning right there, and it remains in the 2030, 2100 trading range, trading right at 2,070 this morning. European markets are up. The Bank of England left rates unchanged, but there was a split vote. 2 voted for an increase, 1 voted for a decrease, and the others voted to hold rates steady, leaving investors there to bet on the side of a cut. I don't know why. That's just what they're doing. ECB inflation data eased slightly in January, but services inflation data held steady. At 6:30 in the morning, markets across the region are up. The UK's up 0.2, Spain's up 1.1%, and all the others are snuggling up in between. The S&P closed at 49.06, so we're back into that new century again, up 60 points, right? The idea that we're going to test 4,800 today is certainly out of the question. That ain't happening. But we most likely will test a January 30th high of 49.31, where it feels just a bit tired to me. You know me, I'm a long-term investor. I only react to news and stocks that I own when it changes the fundamental story. When it doesn't, I check the box and I move on. When it does, then it does. In any event, I'm always happy to discuss it. Give me a call, 212-381-6194. Okay, so now, what are we having for dinner tonight? We're having the bone-in porcini rubbed ribeye tagliata style. Now, tagliata style just means the way you cut it and serve it. So here's what you need to know. For this, you need dried porcini mushrooms. You need sugar. You need salt and pepper. You need garlic. You need olive oil, balsamic vinegar, a bone-in ribeye, arugula, red onion, shaved Parmigiana cheese, and 1 lemon. You're going to grind 1 ounce of dried mushrooms until they're fine. You can use a mortar and pestle. You can even use a food processor if you want. Now you're going to combine the mushroom powder with 2 tablespoons of sugar, 1 tablespoon of salt and pepper, 4 garlic cloves that you're going to chop and mush, and about 1/4 cup of olive oil. You're going to set that aside. Now you're going to make a container of this rub, and up to this point, you can store it in the fridge in a sealed jar and use it, later on for something else when you want. Right? When you're ready to use it, take it out of the fridge. Mix and then mix it up a little bit, and then massage it into the meat of your choice. In this case, we're using the ribeye, right? And you can use, listen, and I use the ribeye because I like it. You can use whatever cut of steak you want. I just like the ribeye because I just like the ribeye. Now, preheat your oven to 400 degrees. Season the meat. Now massage the porcini mushrooms, the porcini mushroom rub into the meat on both sides, making sure you coat it really well. Now, in a large cast iron skillet, one that can go directly into your oven, you're going to add about a teaspoon or maybe a little bit more of olive oil. Heat it up so it gets nice and hot. And then add the steak and listen to it sizzle. You're going to brown it on both sides. Now you're going to take the skillet and you're going to stick it in the oven. You're going to let it cook for 5 to 8 minutes. But depending on the thickness, if you get a really thick piece, it's going to cook more. If you have an instant read thermometer, it should read 135 degrees when you put it in the center. Then remove it, let it sit for 10 minutes, but cover it, tent it with tinfoil to keep it nice and cozy warm. Now, when you're ready, slice the steak at an angle, right? Make it pretty so that you can fan it out on the plate. Lay down first, you're gonna lay down some arugula and red onion, put the steak on top, then drizzle it with a bit more of olive oil and a squirt of fresh lemon juice. Then top with the shaved cheese. Now, this is where you can add a little bit of balsamic vinegar if you want. Balsamic vinegar, you can put it wherever you want. You gotta put it on the arugula and then put the steak on top, or put the steak on top and then do a little of the balsamic. It's really your choice how you want to serve that. But remember, balsamic vinegars, don't put too much. You just want to have a little taste. Okay, in any event, it is Friday. I'm getting ready to go on Stuart Varney at the top of the hour, 9 o'clock. Today it's with Ashley Webster. But look, it's a nice day outside. It's about 68 degrees going up to a high of 72. Will be perfect today. In any event, it is the weekend. Until Monday, take good care.